Hello, good afternoon, everyone. I hope you enjoyed lunch. So, it's a pleasure to be back here at GPW conference. Maybe some of you remember us, we were here last year as well. It's our second time. Very happy to continue our presence here in Poland. Maybe just one quick word of background to HoneyTF before I go into the actual topic. We had the pleasure to list our very first product on the Warsaw Stock Exchange 2 years ago. So ever since, we have been in and out of Poland and Warsaw. We spoke to many investors, to private investors, to professional investors. I think it's great to see that the Polish market is really developing and opening up in terms of passive investing, ETFs. And that's why today we came back, and the topic we want to discuss with you is in the context of geopolitics and policies from the US. What we see with most investors who we speak to normally in Europe, in other countries where we are active, like Germany, UK, France, and so on, Italy, everyone is looking at the moment what is happening in the world, in the US. What is President Trump doing? President Trump has dominated the agenda in the last few months with his policies and with his worldview and the changing landscape of how the world is potentially organized, economically, politically. And it had a big impact on equities, on bonds, on commodities, on many aspects. There's a lot that we could talk about. We picked out 3 topics today which we thought are particularly interesting. Defense, because the defense sector has been, already before Mr. Trump started his second term, it has been a very big development ever since Russia and Ukraine, the Russia-Ukraine conflict started. But it's especially more urgent now with what Trump has said. And I will discuss that in the first topic. The second one will be about gold, because gold is a traditional safe haven asset, something that investors are using whenever they are worried, there's uncertainty. Often when equities go down, gold does pretty well, so it's a risk-off asset. And it has actually achieved new all-time highs just, I think, just this week. So it's very topical. We have a lot of investor discussions, and I will tell you a bit more about that. And then thirdly, cryptos. Cryptocurrencies are a fairly new asset class. Not everyone likes it. Some people are still skeptical. But a lot of people are actually quite positive and very interested in it, and they want to understand what's happening. After Bitcoin hit $100,000, it crashed a bit, back down to 75,000. And just yesterday, it did 10% back up, so it's back at 92,000 now. So what's happening there? Why is it doing what it's doing, and what's the outlook? So I will touch on these 3 topics. Let's start with defense. So just here very quickly to show you a bit what happened in the last 2 years since when we listed our defense ETF 2 years ago. What you see here is in orange, you see the price development of the ETF itself. So investors were right to be interested because the stocks, if you see from 0 all the way to roughly, 160. So it did 60% over 1.5 years. So the performance was very good of the equity stocks in the defense sector. Probably much better than many other sectors. So they did well. We will come in a moment to the question, why did they do well and can they continue to do well? What you see here in blue, I just wanted to highlight that what's quite interesting. These are the flows. The flows means these are the investment flows from investors into the ETF. Now this might look very small, but actually what it means, each of these bars is like $5 million, $10 million. It's a very big scale. So, starting in January last year, we saw really high interest from private investors, from retail investors in defense. And we had investment almost every day of every week. Last year we had investments. And this year, it really exploded even more. So we had, in the first quarter, on a daily basis, we had 10, 20, 40. On our biggest day ever, we had over 100 million new investment into this sector. So the reason I'm showing you that is just to highlight how acute the demand has been from not just professional investors, but particularly this year we see the professional investors coming in as well, meaning private banks, pension funds, insurers, and so on, who have been very cautious before because the professional side does not like to invest in weapons. It's very simple said. The attitude is changing. We see more and more money coming from the professional investment side into this sector. So I think going forward, there's still more room for these stocks to grow in value because there's a lot of money that's still on the sidelines which has not invested yet in the sector because they were not allowed to by their own governance or regulation, or because it just took them time to evaluate it. So if you ask me, is this it? Has it run far enough, the equity performance, or can it go further? I think there are enough investment flows still left over from the professional investment side and the private side to continue flowing into these stocks. So that's the investment perspective from an investor side. Now the question is it justified to invest in defense? Are these companies really growing, and can they produce more revenues in the future to justify a higher share price? And that goes back to the question about what Trump is doing. Trump said, NATO member countries, and this was one of the key actually messages in the last few years. Trump came and said, you are not doing enough. You are not spending 2% of GDP on defense. If you are not doing that, America will not defend you. Basically, he said that publicly, and everyone was shocked. Everyone was like, oh my God, US is really saying that they will not help us. What is Europe doing? Can Europe defend themselves? Yes or no? Is Trump right, or is he just a bully? If you look at the historic defense budgets of the EU, in a sense, he's right. The EU has never spent less than, in these times, in the 2010s, 20, we were somewhere below, 1.5% of defense spending measured by GDP. It was a historic low. You can say lucky so, because we were not in a war period, we were in a peace period, which is very good. So of course the defense spending goes down. But it was very, very low. So yes, Trump does have a point that maybe we need to spend more in these critical times. To be clear, the US is also not spending record levels. The US is also very low at 3% of GDP spending. They used to be much higher back in the, in wartime. Luckily, again, we are not in wartime, at least not globally. But unfortunately, in Europe, we are back in wartime with Russia and Ukraine. So the question is, do we need to get these levels a bit higher, back up to maybe the 4 or 5% level? And that is exactly what Trump now said, his latest message when he was in Europe at the conference. So this, by the way, this is the NATO spending, how much, how many countries, how many NATO members achieved the 2% GDP spending. Finally, in 2024, you can see majority of members do achieve it, 23. Before, it was always, most countries did not achieve it. And then Trump came to the World Economic Forum and said, you know what, it's nice that you achieved 2%, but I actually want 5%. So suddenly he came with this number 5%, and everyone was like, impossible. But actually it's not that impossible. Even the NATO Secretary General said, you know what, we need to spend more. Maybe we need to spend 3.5% realistically. Trump wants 5%. So the truth will be somewhere in between, probably. But then the question is, what does this number mean, 5% or 4% or 3%, for the revenues of these companies? If we really go to these levels, does it mean that the stock price has to double, triple, or is it already priced in maybe? It's not easy to answer, but we try to do an analysis to see what would happen if countries spend this percent on defense. And it's a lot of numbers here, but basically on the left side, we said what would happen with NATO budgets if suddenly today we change and every country spends 5% of GDP on defense. You would have a big jump, $1.2 trillion, so that's $1,200 billion more spending on NATO budgets in total. So that's a huge number. Just to put that in perspective, the Russia wartime budget for this year was roughly $150 billion. So this is 10 times what Russia is spending on their wartime effort today. So the question is, can Europe afford, or can NATO afford to defend itself? Yes, absolutely. We have much more money than Russia. We have, it's a huge, the economies in the NATO country, including Poland and others, are very strong and, wealthy. So we have the money to spend it. That's not the problem. The problem is we need to get to these levels. We need to scale up fast, and we need to interconnect our military, our navies, our air forces to work together. We have 25 countries, or how many countries in Europe. That's much more complicated than just the US doing defense by themselves. So that is the challenge for Europe. It's not the money. And what's more important for the companies is if you look at how much of this money, of this total increase, is going actually into new equipment. Because in the end, a company produces equipment. planes, tanks, protective gear. At the moment, roughly 30% of the total budget is allocated to new equipment expenditure. So if we increase to 5% suddenly, it would mean that roughly 350 billion are ending up in actual spending on new expenditure. So it's a big number, 350 billions more ending up in the pockets of these companies. That is what is driving investors believe that the companies should be worth more. That's why people are investing, because the belief is there will be big revenues going into the into the pockets basically of these companies, because governments have to rearm. So this is the basic story behind why people are actually interested in defense. We looked at it a little bit more nuanced, because we said, you know what, it's unlikely that we change now from today to tomorrow 5% suddenly. So you need to give it maybe a 5-year plan. So we said, okay, let's look over 5 years. If in 5 years' time we have two scenarios, a best case scenario at the top and a worst case or low case scenario at the bottom. Meaning that, okay, what is the best case? Well, the best case is every country in NATO goes to 5% spending, the GDP is growing by 2% every year, and the ratio of how much they put into new equipment is going up a bit. So in the best case scenario, you actually end up with 1 billion more spending in these 5 years that go to expenditure, to the NATO, to growth expenditure. In the worst case, it's goes to 600 billion, which is still 150 billion increase compared to before. So if you take the best case scenario, which doesn't look completely off today, if you look at what the EU has said now, the EU just recently published a new rearm EU plan, where they said we are giving up to 800 billion of different loan and facilities to EU members to finance expenditure. These numbers look quite realistic now. So if you say, the 600 billion increase in 5 years, how does it compare to the revenues of these companies? The 100 largest defense companies in the world are currently producing revenues of 650 billion combined. So basically you are doubling the revenue of these companies by doing this increase over the next 5 years. So doubling of the sector in revenue terms, and we think this is one of the main reasons that drives the equity price performance. And we think it's not yet all priced in, because there's still a lot of uncertainties. We don't know, not all these plans are still very vague. So we think there's more room for this theme to grow. And that's really it. Just 2 words quickly about how we make it investable, in case you're interested and you say, okay, I would like to invest. We have 2 ETFs. We have a global ETF, a global defense ETF, and we have a European defense ETF, which invests specifically in European companies. And we have a 2-tier approach. We invest in industrial companies and in cyber defense companies as well. So we're not doing just the producers like Rheinmetall or BAE System or others, Thales and Safran. These guys build the hard equipment, but if you look at what's happening in Ukraine and Russia, modern conflict is also happening very much digitally. You get your infrastructure, your water or electricity power plants gets attacked by a digital cyber attack to stop them functioning. That's much more dangerous than trying to hit them with a bomb, which is more unlikely. So you need to defend yourself, your civil infrastructure and your military infrastructure with modern cyber defense. You need AI for modern coordination between troops, data security, data connectivity. Everything works in a digital space these days. So for us, it's very critical that you have both. So we have a roughly 50-50 split in the portfolio. You can see it here. At the moment, tech is roughly 40%. Sometimes it's more, sometimes less. Depends how the price is evolving. And this is the global ETF. US is 56%, but there's quite a lot of European names as well in this global version. And then we just recently launched a 100% European version, where you have dedicated European exposure in case you want to invest just in the European rearming case. That's it. Here are the, just some facts about the fund. You can take a look at that, in your own time. Go on honeytf.com, or you will find all the details there about the products. There's not much more to say for the moment. In the interest of time, because I think I used up a lot of time on my defense part, I will try to speed through the other two topics now, which are also very interesting, but defense is maybe the most interesting. So gold. Gold is the other side. It's very related to that, right? When things are looking bad and the economy is doing, when there's a lot of uncertainty, not necessarily bad, but there's uncertainty, people don't know what's happening. And that's exactly what's happening with Mr. Trump now. One day he says, I give tariffs, the other day he takes the tariffs back. One day he decides something else crazy and invites, says, I'm making peace in Ukraine, Russia, then he shouts at the president of Ukraine. Then something else happens again. You just don't know exactly what he stands for, and you don't know what he will do in the end. So, one day, what people do, they tend, in these moments, people often tend to reduce their risk in the portfolio. They say, okay, you know what? Let's take a step back and wait until this uncertainty is being reduced. To do that, you normally sell risk assets. You go out of stocks, because stocks are the most risky thing you can do. You probably sell Bitcoin and cryptos. That's why we saw the crypto correction, because cryptocurrencies are a risk asset at the moment, a very risky asset. And you go into safe haven assets, like, for example, gold, because gold is stable and has a safe haven character. So that's what we saw. Gold has hit new all-time highs. But beyond Trump, it's not just Trump. Gold actually had a very, it has a few other drivers, and I go through them. So one of the main drivers in the last 3 quarters, what you see here is the demand from financial investors for gold ETFs specifically. So since beginning of 2022, for the last 2 years, so 8 quarters or 9 quarters, you actually had negative demand from investors, meaning that financial investors were selling their ETFs. They were already holding some gold, and they said, you know what, I don't need gold now, because at that time in 2022, interest rates started to rise in the US. So people said, you know what, I'm buying US government bonds. They give me an interest rate, I get 3% return, 4% return. Gold does not give me a return. And they're also pretty safe, right? The US government is very safe. So I don't need gold, maybe. So they were selling gold. Because for 15 years, there was no interest rate. Suddenly, the central bank started raising interest rates, which has not happened since the financial crisis. So it was a tough time for gold in terms of demand from investors. The price in gold was actually quite stable. It did not drop. It was quite interesting. And now we have finally, in the last 3 quarters, we see demand from the US and demand from Europe coming back in the market. So you have support from financial investors. And we are not yet at all-time highs. So this peak here is the all-time high when financial investors had the most holdings in ETFs, in gold ETFs. And then you see it went down a bit. And today, we are still at high levels, but we're not at all-time high levels, which means there's potentially more support for gold, more support from investors coming into the asset class, and continuing to support the gold price going forward. Because the question is, again, the price has gone up very much. Can it go further? We think this is one positive aspect that shows that it could be supported a while longer. The other important support that we have is from central banks. So central banks have been one of the biggest buyers of physical gold for the last 10, 15, I think, 14 years now, 15 years. So they kept buying to diversify their reserves, because central banks often have monetary reserves on their balance sheet, and then they diversify in different currencies and different assets. Central banks tend to, on average now, they like to diversify the portfolio a bit and also keep the risk manageable and lower. So one trend we see now is, for example, diversifying out of US assets. So people are a bit, concerned. You saw the dollar has lost in value in the last few weeks quite a bit. The reason for that is that people are selling the dollar. They're selling assets that are denominated in US dollar. For example, government bonds of the US. The yield has also gone up for US bonds, which shows that investors are a bit cautious of the US, saying maybe the US, the dollar is losing its status as a reserve currency. I don't think yet, but that's one hypothesis. Maybe that's happening. So what do you buy instead of the dollar if you want safety? Well, you buy gold, because gold is very stable and safe, and you don't take risks. So that's what the central banks have been doing. And Poland is actually the biggest, one of the biggest buyers at the moment, the Polish central bank, of physical gold. I think the governor of the bank said they want to have roughly 20% of their reserves held in gold. And this is also a bit, I think, indicative. When your country or your institutions or you as a person are close to things that are volatile, they are risky, you know, also the conflict, Ukraine, Russia is not far from here physically, right? And I've had conversations with people, investors, people in the room normally. You're probably much closer than some other countries in Europe. So of course, in the mind of maybe the central bank governor, it is, let's go for something safe. Let's make sure that our asset base is solid and protected. So you see this, you know, this thinking of China as well. You know, China is probably worried about the fight with the US, the tariff fight, sanctions, all the stuff that's happening. So they are selling their government bond reserves that they hold in US government bonds and buying gold instead. So this trend has continued. There's a risk, of course, that with prices being so high in the gold space at the moment, that maybe central banks will take a pause and say, okay, let's wait for prices to correct a little bit. So maybe we'll see some, you know, a pause in buying from the banks in the future. We'll have to see. So far, it has, as I said, it held very stable. We had some weaker years, you know, where it went down a bit, but it was never negative. It was always positive for the last 15 years. So we think this should continue to be a strong supporter for gold. And then finally, the last point I want to highlight, and sorry, again, a lot of colors, but ignore this stuff that's just the price of gold. It's the two lines at the top. They are the real interest rates in the US. Real interest rate means inflation adjusted. And that's important because historically there was a correlation between gold and real interest rates. Lower real interest rates means it's normally better for gold, because if you don't get a yield, as we said before, if you have the option between a government bond, which is supposedly very safe, and gold, which is also very safe, but the government bond pays you interest rate, then maybe your preference is to buy the bond. If it pays you interest rates after inflation, which is positive, why not take the bond? Same risk, kind of, but interest rate. But if yields are coming down on these bonds, there's no reason to switch, so you rather go to gold as a really, really safe haven, and you only lose a little bit of interest rate yield. So the rationale is here that falling real rates should support gold going forward, because bonds are less of an alternative. So that's another signal that maybe gold could remain supported in the future despite its strong growth already. And just as a final chart, again, a lot of color, a lot of points here, but what this shows is basically, the question here is, can it go further, or have we gone too far for gold? In light blue, if you can see, you know, these bars here, they show you how many weeks the bull market has already gone, and that's the history. So you had some very, very long bull markets of, you know, 440 weeks, huge. You had some smaller ones of 30 weeks, 140. At the moment, we have 128 weeks, so we're kind of in between. So it's not extreme. We're not like super long. We're not short, but not super long, so, you know, it could go on. And the other question is not just how long was it, but how high was the return? So at the moment, you can't see it, but it's 86% from the start to where we are today. So 86% plus increase in gold price. That's, again, it's not extreme. You had some times which were lower, with 60%, and then it stopped. But you have other times where it was, you know, 150, 280%, or even more. So there's no indication here that says it has to stop or it has to go on. It's kind of neutral indicator. So, you know, everything is possible, basically, is what the chart is saying. And combined with the other arguments from before and the general fear and uncertainty in the market, we feel quite comfortable that gold has a stable outlook at the moment, in our view. So that's about gold. For those of you who are interested to invest in gold, but say maybe I like the equity part of it more, there's one interesting chart here just to show this is the ratio between mining stocks in the gold space and the gold price. On average, you know, that's the average here. It goes sometimes up, sometimes down. So sometimes when it's up, it means that the equity mining stocks, so the companies, are valued maybe too high versus gold itself. When it's low, it means maybe they are undervalued, and there's a potential here. The connection here should be quite straightforward, because a gold mining company, the only thing they do is sell gold, right? They build a mine, they have costs to do that. Once the mine is built and you have an operational cost, every kilo of gold that you produce costs you roughly the same. They increase over time a bit, but initially it's kind of a certain price of getting it out. So if the gold price is now going to all-time highs of $3,400, and it was $1,800 a year ago or something, so if the gold price doubles, the company should make double the money, or even more actually, because the cost base is staying roughly the same, but you're making more revenues. So they have something called operational leverage. That's why normally you see a gold mining company, when the gold price goes up, the expectation is that the price of the company goes up 1.5 to 2 times. We call that a higher beta to the market. And when it goes down faster as well normally. So you would expect it to go up faster, but this has not happened in the last 10 years. Mining equities have not performed well, and the question is why? Is it justified? Did investors make a mistake and not invest in the equity stocks? Or do the equity companies make something bad? Bad company management, and it's not worth investing. There are bad stocks. There's a big debate in the investment community. Some people say, you know what, these guys don't do good management of a company, because all they do is they take the money that they make with the gold, and then the CEO is making some M&A deal, because he has 3, 5 years, 10 years maybe to run the company, and then he retires. An M&A deal you can do in a couple of years, and then he gets a nice profit. If it goes well, he can get a bonus. If it doesn't go well, bad luck. If you build a mine to get more gold and make more profit for the company and increase the share price, to build a gold mine takes you 15 years or more these days. By the time this project is realized and finished, the CEO is gone. He will not benefit from that. The next guy will benefit. So that's a problem. It's a misalignment of incentives. So that's why historically they have burned quite a lot of money in the last commodity bull run, the companies, when investors did invest in the companies, in the stocks, and there was big disappointment that they actually did not perform as they should. So now investors are a bit scared, and they say, you know what, I've seen it again. I'm not investing. But we have some investors who say the opposite. They say, you know what, these companies have learned a lesson. They are doing better management practice now. The costs have been cut down. M&A that's being done is actually more sensible. It's not silly. So this is a great opportunity. Whether they're right or wrong, honestly, I don't know. You need to make up your own mind whether you believe in that. We have a bit more research if you want to go deeper into the topic. At least in the last 6 months, the hypothesis was true. In yellow, or this is like year-to-date 4 months, but also if you look at 6 months or a bit longer, in red, the companies have done roughly twice as well as the gold price. So the gold price has done 20%, and the companies have done 40%. So pretty much exactly double, as I mentioned before. But it's a short time horizon. 3, 4, 6 months is not yet that significant. The question is, can they continue this for the next year, 2, 3? We speak to some professional investors who are very convinced that this is a great opportunity, and they invested significant money in this trade. I have others who are more careful and skeptical. So it's really, up to you to decide. But we think it's definitely worth looking at this sector. So with that, very quickly, if I'm probably over time, but if I can take 5 more minutes for the last crypto topic. This, by the way, is we have a special mention deserves for our gold ETC, which we listed here on Warsaw Stock Exchange. So it's the first gold ETC in Poland, listed on the exchange, which you can trade in Polish zloty. It's 100% backed by physical gold, so it gives you one-to-one exposure to the price of gold. You can buy it on exchange in your broker account, wherever you have it. If you want, you can even get it physically. So we allow for physical delivery. You can request to get gold coins or bars sent to you or you can sell it on the exchange as you want. We work together with the Royal Mint, which is a British institution that has been around for 1,000 years. Isaac Newton, the famous physicist, was the master of the mint, they call it. He was the boss of the mint a couple hundred years ago. So it's very, very interesting history. I can only invite you to read up on it. They make this beautiful coin called the Britannia. And the gold that we have is stored with them in Wales, in the UK. We put it there in a safe, it's protected by the military. I think even the Queen or King had their gold there at some point. So we're very happy about the cooperation with them. And it's a very liquid, it's a very easy way to get exposure to gold. It's more efficient than buying gold coins or bars physically, because A, you have to store them yourself then, and B, you pay a high premium, normally 3, 4, 5, sometimes even 6, 7% for someone to print, to make the coin, to make the bar. So here, the total cost of the product is 0.25% per year. That's all you kind of pay, plus, of course, the commission for trading on with your broker. But apart from that, it's a very efficient way to get exposure to physical gold. And you can do it in Polish zloty, in your home currency here. So that's that. Very quickly, before I run out of time, cryptos, the digital gold. Not yet, not quite, I don't think so. But some people think it will become the digital gold. I think Bitcoin could become the digital gold one day. At the moment, it's not reacting yet like gold. It's reacting more like a risk asset. It's reacting a bit more like equities. When we had the big sell-off in equities now with Trump and everything, Bitcoin and other cryptocurrencies also went down fast and strong. Not as fast and not as bad as in previous cycles. So it's getting a bit more mature, and some people think that in the future, in the next correction, in a few years, whenever that happens, we will see Bitcoin react a bit more like gold. We'll see, I don't know. Again, there's arguments in favor and against. But what's important at the moment, so there are three, people ask us what's happening in crypto. It went up to 100,000 with Trump. Trump was super supportive. Then he comes into power, and then it crashes to 75,000. Why is that? What happened? Is he not supportive? He is, I think. So there are crypto-specific factors that you need to look at. There's macro factors, and there's what's called on-chain factors. These three areas are driving or are determining what's happening in the crypto space. At the moment, macro factors are the key thing that's driving the price. On-chain means that's stuff specific to cryptos, meaning when you look at the blockchain of Bitcoin, for example, you can say, how much money is on exchange? When it's on exchange, it means it's liquid, it means it's hot money, and that means it can go out or in quickly, so it's kind of a negative. If a lot of money is not on the exchange and not hot, but cold somewhere in a wallet far away, it's good for the price. So that's like very specific indicators to Bitcoin blockchain. I will not go into detail there because it's a bit more complicated. They don't play a huge role right now. They are important to the asset class, but right now I will focus on the macro side because that's really, we think, driving the development. And the crypto-specific factors, I think these will come more into effect over the course of the year. Crypto-specific is Trump. So Trump came in and he said, he was actually quite negative in his first term back then. He said like, oh, it's, Bitcoin, super volatile, I don't believe in it. He even said like, it will make the big tech explosion look like baby stuff. And then, of course, after that happened, and now because he wanted to become president, and he has all the crypto fans on his side now, and he said like, congratulations, I brought Bitcoin to 100,000. You can thank me later. So in typical Trump fashion, he turned around, and now he's a crypto bro. And that is actually true, and it's probably one of the strongest supporting factors, in my personal view, that will be for the next 4 years. Because the US has so much power. We have seen it now. Every time President Trump and his administration says something, the world reacts. Equity prices are going up, down. Bond prices are reacting. The dollar is reacting. Crypto is reacting. So what he decides matters. And on his side, give me 2 minutes and I'm done. He has a lot of lawmakers on his side. In blue, you see the guys who are crypto-friendly. So he can bring regulation and law to the country and make it happen. Just today I read he invited, I think, the 200 or 250 largest holders of his own Trump meme coin to a dinner with him, and the price of Bitcoin reacted immediately. So he has a lot of things that he can say to move the market, and he has a task force. He gave it 6 months to come up with regulation and recommendations for the industry. So it should come, I think in the next few months we will hear more concrete regulation. I think he focused a lot on tariffs and other parts of his policy agenda in Q1 now. I think in Q2 we can expect more to come. And the last point I will make just on that macro side I mentioned. At the moment, there's something called, Bitcoin is in blue here, and in black you had the global growth expectations. We've seen a strong correlation normally between Bitcoin and what the world thinks is happening. Are things growing? Are they going back? And we are in an environment of real fear now that the world is going to recession and the US is going to recession. And that has really drawn Bitcoin down. I think we can potentially overcome that with the policy from Trump that I mentioned, and a couple of other effects, like last year we had the halving of Bitcoin, which means the supply of Bitcoin is reduced structurally. That normally kicks in with 1, 2, 3, 400 days delay. We are at day 360 now. On Sunday is the 1-year anniversary of this halving. So we expect this effect to kick in more and more in the next few months. So watch the space, look at what Bitcoin is doing halving-wise, supply-wise, look at the macro factors. Improving macro landscape we think will be positive for crypto, and we already saw now a little reaction. And watch the Trump policies, what he's doing. He can move markets, and he is at the moment. I think I read somewhere 8 or 9 out of 10 of his policy of his cabinet has exposure, private exposure to crypto. So they're invested. They will not shoot themselves in the foot, I think, and make it crash and go away. I think they are rather on the other side, being positive. So I leave it at that. Thanks for giving me a bit of extra time. I don't think we have time for questions, do we? It's end. Okay, thank you very much. If you have questions, please feel free to come over later.